We just saw what is happening in China. ASEAN has a strong trade and economic relationship with China. How did ASEAN countries cope up with COVID? How are they managing post-COVID? What are some of the macro trends emerging from ASEAN? These are very important for all of us. We have a very senior and well-experienced macroeconomist, head of emerging market Asia economic research and chief economist for ASEAN at JP Morgan to provide us a perspective on the subject titled Some Observations of Secular Macro Trends Pre and Post-COVID in ASEAN Countries. The presentation is a very detailed one, and I'm sure it would enrich us all. Before I invite the keynote speaker, Mr. Sin Men Aung, a brief introduction about himself. Mr. Sin Men Aung joined JP Morgan in October 2003. He is the head of emerging market Asia economic research and chief economist for ASEAN, and also covers regional macro themes for emerging Asia. He has also worked as a rates strategist and sovereign strategist within emerging Asia for JP Morgan. His work as sovereign analyst has been recognized by Finance Asia, and he was also a member of the top-ranked Malaysian 2 team and runner-up of Indonesia team in 2016 and 2017 ranking. He holds a BA and MBA from Cornell University. With this introduction, over to Mr. Sin Men Aung.
Great, thank you very much, Vatsa. And if I may just share my screen, I think that would help in the general discussion. I mean, what I'm going to do today, hopefully, is just to give you a foretaste of the general macro trends that we're seeing and trying to understand what drives those trends and whether they're durable or not. And I think within that context, there are two broad trends that we think we're seeing. The first one is that we're seeing low rates, and we think they're persistent. They're here to stay, and this will have an impact on investment behavior. And the second, I think, is a more recent trend, is that we're starting to see China as a regional anchor, not just for trade, which it has been for a while, but also in terms of the currency movements as well. That's an important dynamic, because what we think we're seeing in the last several years, particularly since 2016, is the emergence of China as a regional currency bloc, which is effectively creating the anchor for relative Asian currency movement. So that really speaks to this broader theme of greater trade integration within the region. So let me just start with a very simple slide or simple observations. But I think what we like to do today is just to give you a sense of what we think has been happening over the medium term, over the last 20 years, and trying to put some sense, at least interpretation, in terms of what we think is driving these trends. And I think the first thing you'll see on these charts, particularly in the left chart, is this almost gradual slide in core inflation. So core inflation is what we as economists would describe as underlying inflation. So this effectively strips out the volatile components such as food and fuel and looks at underlying inflation. And what you'll see on the right chart, particularly in the blue line, is that following this trend up and then down in core inflation, we've also seen a very clear trend in terms of the policy rate hitting a peak of roughly about 5% in the region, and now going below 3% in what has effectively been a very steady decline, interest rates starting from its peak in 2008. And so the question that arises from all of this is that these trends seem quite durable, and we've tried to understand what we think is driving these trends in the past and whether these trends we think will continue in the future. So I'm going to spend the next few minutes trying to understand what in particular is driving this low inflation dynamic, which is also giving rise to this decline in interest rates, which we think will be here to stay for an extended period of time. So I think the first thing we do is we need to understand the underlying dynamics of inflation. So inflation in Asia, you can think of as two dynamics. One is headline, which is the blue line, and the core inflation, which is the orange line on the left chart. And what you'll see is that the blue line tends to be much more volatile, and there's a much more steady dynamic behind the orange line, which is core inflation. When we break down inflation more specifically in terms of headline inflation, what we find is that the bulk of the blue line is driven on the right chart by the ups and downs in food and fuel prices, meaning that it's driven by these volatile components. Now, if you take out these volatile components and leave the underlying trend, you get this dynamic called core inflation, which is what we refer to here in this previous chart on page 4. Now, the important point of this is that it's actually much more stable. And what you'll see is that it's also been a fairly consistent downtrend starting in 2012. And the question is, why do we think that's happening despite these ups and downs in food and fuel prices, which I'm sure we're all experiencing? And the simple answer, we think, in our interpretation, is that underlying inflation, or core inflation, if you will, is a reflection of the underlying dynamic around labor markets, employment income. So the whole idea behind this is that the reason why we have core inflation declining is because we're seeing employment incomes slow down over the last decade or so, starting around 2011, 2012. And when we look at this more specifically, the question is, why is this happening? So there's a cyclical dynamic, which is over the business cycle. And the simple reason is because if you look at employment and real GDP, there's a general correlation. And this is really coming about because real GDP itself is slowing and therefore employment is slowing. But there's also an interesting dynamic here, is that not only is employment slowing down, but wages are slowing down as well. And so this in itself is giving rise to this dynamic around softer inflation. So what we really need to see is an acceleration in growth, which we don't think is going to happen over the medium term. We may get the near-term pickup given the relaxation of COVID measures and stringency measures, but the long-term trend for growth, in our view, is going to be slow. And there are multiple reasons behind that, why we think that's the case. And one of the reasons is because we are effectively going into an aging population dynamic. So what this means is that if you look at age at the next 15 years, the number of people who are going to be aging and retiring is going to be accelerating at a rate that's going to be unprecedented. And so this in itself will create lower demand for goods and services, or different kinds of goods and services. And the second point is that the amount of people joining the labor force will also decline as people retire, so that the overall net labor force growth is going to be decelerating. So this is an important dynamic because this is structural, this is not cyclical. This also has an interesting dynamic on the way interest rates and inflation behaves. And let me just talk you through the logic behind that. So the left chart shows you dependency ratio. So what is a dependency ratio? The dependency ratio is a measure of people who are age 65 above, effectively retirement age, divided as a proportion of those between 25 to 64 years old, which are effectively people who are supposed to be in the labor force, in other words, pre-retirement. And what you find is that if you take a place like Hong Kong, and just before I start on that idea, you'll notice that almost all of Asia is aging much faster than the world average. The only countries where we're not seeing significant aging pressures are Malaysia, India, Indonesia, and the Philippines. The rest of developed Asia and China in particular is aging very quickly. And just to give you a sense, in Hong Kong, the current dependency ratio right now is 25% in year 2020. So that means there's one retiree supported by 4 people who are aged between 25 to 64. By the time we get to 2035, that number will go to 50%, meaning that for every one person above 65, there's only 2 people working, which means therefore the burden on the working population to support the older age workers is going to, or those who are retired, sorry, is going to be very, very high. It's going to be remarkably high. And at the same time, in the case of Hong Kong, what happens is when you enter retirement, you then effectively call on your pension fund to pay you an income when you retire. Now, the issue is this: not only are people aging quickly and entering retirement, but if you look at the replacement age, the replacement rate for pensions, it's about 40% in the case of Hong Kong. Korea is not much better. But what this pension replacement rate measures is the amount that you get paid up as a share of your last drawn income. So with people aging and retiring, you only get, in the case of Hong Kong, 40 cents on the dollar that you earn before retirement. So what does this mean? So if you retire tomorrow, you only get 40 cents of your income. This may not be enough to sustain your living expenses. So what do? People then re-enter the workforce in terms of once they retire. So this is actually quite ironic, is that when you should be retired, enjoying your retirement, most people cannot actually do that. So what do? They re-enter the workforce, especially these countries where you're seeing fairly large increases in dependency ratios and where pension payouts are quite low. So one way to look at that is that if you look at labor force, which is a total labor pool, and you break down the labor force growth by age, you'll find that the blue line, which is those above 60 years old, is actually adding very steadily to labor force growth. And ironically, the younger workers are actually declining only because the younger are becoming older and they eventually retire, become above 60. And what this means is that we're effectively seeing an aging of the workforce as to be expected. But what's also very interesting for us is that not only is the workforce aging, but we're finding that the people who are remaining in the workforce beyond retirement age is increasing. So what we find is that if you look at these countries, Hong Kong, Korea, Taiwan, EM Asia 5, Singapore, Thailand, is that the participation rate for workers above 60 is actually increasing quite quickly. Now, what does this do to wage setting? And what we do here is that we effectively look at what happens when you add older people into the workforce. What does that do to nominal wages? And the fact that we have a negative sign means that the more older workers you add into the economy, into the labor force, the lower incomes become. And why is that? Intuitively, it's because there's no bargaining power when you're an older worker. In other words, you will basically work at the wage that you're given. So this effectively depresses incomes, and this is adding to this broader downward pressure in wages, which is not just a cyclical component, but also there's a very strong structural element to this as well. So which means, therefore, that we have a fairly strong underlying trend, downtrend in wage behavior. And that's just on the supply side. So in other words, the supply of workers, because they need to work, are not so price sensitive. The second thing I think is worth noting is that we're also seeing the significant rise in digitization. And the way we capture it in Asia is that the demand for tech product, basically semiconductors, is effectively gone on an almost non-linear trend, almost parabolic trend, starting around 2016. And this effectively reflects the demand for semiconductors for data centers, AI, robotics, etc. And this is one of the concerns we have, is that as digitization becomes more the norm, the ability of workers to keep up with digitization, to effectively keep up with technology is going to be limited, so that the incremental demand for work or labor also depresses as well. So what we have, therefore, is not just a supply side that effectively is flattening as people age, but we have a demand side for labor that also could be slowing as well. So the combination of these two factors over the medium term, we think, will continue to lead to this general decline in employment growth and general wage growth over the medium term. In the immediate future, the next 6 to 12 months, we should see things recover as we exit COVID. But beyond that, I think these are the trends that we need to be mindful of. So what do we do with all of this? The simple answer, and let me just run this forward, is that we expect, therefore, underlying inflation to decline over the trend. And this is effectively allowing rates to come lower. And it's also helped, aside from what's happening in the labor markets, core inflation, by the Fed's commitment to what we call LVLY, or lovely, which is low for very long yields, through this average inflation targeting framework that they introduced last year. So what is this effectively saying? It's effectively saying that the Fed will let inflation run hotter before it starts hiking. So what this effectively suggests is that the Fed will be very, very patient and will effectively let inflation run, which means inflation will run quite hot, rates will remain quite low, and more particularly, real yields will remain quite low for as long as the Fed continues on this LVLY policy. And you can see that also in the general expectations for long-term rates, which is the 10-year bond yields in the region. What the 10-year bond yield in the region tells you is that we don't see significant risk of a significant tightening cycle anytime soon. And you see that by the fact that bond yields in Asia are effectively coming down lower and lower and lower through the medium-term cycle. Now, what does this mean for an investor? These are very troubling times, because as an investor, your real return used to be 2% from 03 to 08. And more recently, from 14 to 20, it is 1%. So if you're a pension fund, imagine what's happening is that you cannot eke out these kind of returns anymore because bond yields are coming down. So your risk-free rate is coming down. And so what do you do as an investor? You now look for alternatives. And how do we see that manifest? We see that manifest is significant increase in outflows looking for yield product. And in an environment where yields are coming down and where the Fed is committed to low for very long, the opportunity set that's available to you as a risk-free asset investor is becoming lower and smaller as each year progresses. So this is the issue, is that you now have, again, an aging population, as we see here. You have increasing demand for retirement payouts and an environment where yields are coming down. So what this means is that this low for long environment, we think, will stay. And at the same time, there's going to be much more demand for alternative assets separate from fixed income, because fixed income yields are coming down as well. And one of the ways you see that is effectively pension funds and long-term funds looking for alternative assets to effectively complement their existing holdings. And because rates are coming down, the opportunity cost for holding bonds is actually increasing, meaning that it's becoming more and more costly to hold bonds that are effectively going to be negative yielding over a period of time. So this is also changing behavior as well, and we think these low for long rates is going to be quite durable. And let me just wrap up on another point. As I mentioned before, we're starting to see China increasingly dominate trade. And not only that, we started to see in 2017-18 the opening up of China's capital flows or its capital market for investors, such that you're now seeing very, very large inflows into China. So what we're seeing in China is that it not only dominates the trade relationship in Asia, but it's also becoming a very dominant player in the financial marketplace, because it started to open up its debt markets for foreign investors, and that's really attracting substantial inflows. Now, the point we want to make through all of this, and this is the general trade exposure of Asia to China, it used to be roughly about 7% in 2002. It's now 25%. So that means on an average basis, a country 20 years ago would only have about 7% of its trade exposed to China. Now it's about a quarter. It's a quarter now. That's very substantial. And what does this mean? It means that so if you look at relative currency movements, the dominance of the CNY is effectively increasing, because that's your primary trading partner right now. And we see that multiple ways. One of which is we're starting to see a general convergence of Asian effective exchange rates, or basket currencies, converge to the CNY. This started to happen in 2015-16, and this is actually occurring for all currency pairs that we see in Asia. And if you start looking at what we call CNY dominance in terms of the actual, in terms of determining currency movements for Asia, what we find is that from 2005 to 2014, the biggest driver of relative currency movements in Asia, or the influence, was actually the euro. In the last 6 years, since 2015, that has now been replaced by the CNY, so that it now explains roughly about 60% of movement in Asian currencies, with the euro now less than 10%. So what this effectively tells us is that starting in 2016, 2017, there's a much higher degree of regional correlation with the CNY, partly as a function of its increasing in trade, partly because of its integration to financial markets. And we see that also in bilateral currency movements as well. Because if you look at the EM Asian ex-China FX movements, which is the orange line, it used to move quite randomly. And then CNY also used to move in a fairly uncorrelated fashion with Asian currencies. But starting in 2017, you can see that the ups and downs in the blue and orange lines are now much more highly correlated. So if you run a very simple cross correlation, you'll find that the correlation between Asian currencies and the CNY is now the highest it's been almost in 2 decades. And we think this is here to stay. And this, in our view, really reflects the idea that we're seeing much tighter integration in trade, and also in terms of financial flows between China and the rest of Asia. And we're effectively becoming a de facto CNY bloc in Asia as well. So those are I would say those are the key points that I like to highlight. And just to reemphasize them again, which is that they're effectively that we expect to see low rates for an extended period of time for multiple reasons, some of which is cyclical, some of which are structural, but it also creates problems or headaches for pension funds and large funds who need to find alternate assets to effectively boost up their returns, because the pension demand on them is rising quite quickly as people retire. And the second point that we tried to make today is the idea that increasingly we're seeing China as becoming the dominant driver of regional currency markets in Asia for multiple reasons, which I've just mentioned earlier. So let me stop there and hand it back over to our host, Vatsa. Back to you, sir. Thank you.
Thank you, Mr. Sin Benong. That was indeed an excellent presentation, I would say. So lucidly, you have highlighted what is the way which you are looking at the market. 2 or 3 key takeaways. Low rates are here to stay. Pension funds and other long-term funds are looking for yield-seeking assets. Perhaps precious metals could be an answer to that. I don't know, I'm just guessing. And the third one is not only trade, but currencies of emerging market Asia is highly integrated with CNY. Thank you so much for so well articulating and making it as simple for all of us, though you have put in years of experience, but it is like, you have made it so easy for us to also understand. Thank you so much. Thank you.
Thank you very much, and it's a pleasure, sir. Thank you.
Thank you very much.